Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q2 22. My name is Gary Stockton. I work here in marketing in Experian. Before we get started, I want to cover just a few housekeeping items. If you would like to follow along, we've dropped a PDF of the slides in the handouts area. We'll also include a link to the slides in our follow-up email. And if you've not yet received your copy of the latest Experian Oxford Economics Main Street report, you can download that at the link there on screen, bit.ly/Q222MSR. We'll send a link to that in our follow-up email as well. During today's webinar, we're going to be discussing key findings in the Experian Oxford Economics Main Street report for Q2 22, as I said. Today's talk will be presented by Brody Oldham, Vice President of Commercial Data Science for Experian, and Kathy Bostjancic, the US Chief Economist for Oxford Economics. Brody leads a team made up of statistical consultants, scientists, modelers, and engineers with diverse skill sets who provide clients with leading-edge analytics-driven information solutions, services, and data visualizations of actionable insights. He writes and speaks on behalf of Experian about the trends in credit markets. Kathy is responsible for forecasting and assessing the US macroeconomic outlook and how it will influence Federal Reserve monetary policy and financial markets. She has an extensive experience providing insightful global economic and financial market analysis to investors and the Fortune 500 business leaders. She has a deep understanding of the workings of the US economy. We encourage you to submit questions during today's talk using the Q&A applet in the GoToWebinar tool panel, and we'll try to leave some time at the end to answer those. If not, if we do run out of time, they will be routed to our experts and responded to following today's webinar. And now I would like to hand things over to Kathy. Let me pass the keyboard control to you, Kathy.
Thank you very much, Gary, and thank you for the kind introduction. Happy to speak with everyone today. Okay, so at Oxford Economics, what we have assessed that why the U.S. economy certainly registered two negative quarters of real GDP growth in the first half of this year. We would say that we have evidence that there's a technical recession, but not yet a full-blown recession. And what you would really need for that, and that's would be dated by the National Bureau of Economic Research, is you would also need to see labor market conditions deteriorate quite sharply and see an increase in the unemployment rate. We need to see consumer spending retrenching, and we need to see a pullback in business investment. And we haven't seen that as of yet. So currently, what we're seeing is very slow growth, and in large part, which I'll talk further about in upcoming slides, is because the Federal Reserve is raising interest rates at a very rapid pace, the quickest since the 1980s, in order to tamp down on inflation. So, but what we're expecting is that growth for this full year will be somewhere around 1.7%. We see a rebound in the second half of the year, particularly the third quarter looks like it's on track to be just a little bit under 2%, but then it does slow in the fourth quarter to 1.3% according to our estimates. For the full year of 2023, that's when we're seeing growth slow enough that we see recession odds rising. We again, we're not there yet, but that's the vulnerability in our opinion. And analysis. So what you see on the right is that economic growth 2021, very strong, 5.7%, steps back to 1.7 this year, and then further to just 1% in 2023. Now, if we take a look at the next slide, see that recession odds are indeed rising, and they're quite elevated. And particularly what we see is that information that we receive from the Treasury yield curve shows that short-term interest rates are actually higher than long-term interest rates. And that's the inversion of the yield curve. And that tends to be a very good leading indicator of economic downturns and recessions. Also, the 10-year less the 3-month T-bill rate. Some, particularly the Federal Reserve, thinks that's even a better indicator, and that also is quite elevated. So while right now economic activity remains robust and we think there's enough momentum to take us through this year, next year, again, the odds of a somewhat of a mild recession, certainly are increasing. And we're going to have to watch how the Fed Reserve manages these risks. Do they continue to raise interest rates with really the unconditional focus of lowering inflation, or do they start to ease a little bit on the rate increases because they see that economic activity is slowing? And how does the labor market, continue to manage? If we could look ahead, maybe 2 slides. It looks like we're having a little bit technical difficulties here. So these are well, maybe just pause here for a minute. These are the charts that I was talking about before. These is our recession graphs of our recession models. And you can see the one on the right that relies very heavily on the Treasury yield curve again, which is a very good leading indicator of changes in the business cycle. The one on the left, though, is a bit more encouraging, and that includes the Chicago Fed's National Activity Index. And that's not quite at the threshold that's, indicates we are at a recession. Now we can take a look at the next slide, which focuses on the labor market. So hiring is still very strong. We just got the August employment payroll data on Friday, and it showed an increase of 315,000. Now, we are seeing a step down in employment growth, but that's natural. The type of gains that we saw a year ago were not sustainable. It was really sort of the post-COVID, even though COVID is still with us, it was sort of the rebound from the COVID shutdown and lockdowns. That type of employment gains were never, thought to be sustainable. So this kind of natural moderation in employment is both healthy and still strong. 315,000 in normal times would be really boom gains in the labor market. But what you could see here by the chart is that we show the levels of employment by sector relative to February 2020, so right before the pandemic really spread in the US. And you can see it's quite uneven. Now, professional and business sectors, transportation, retail, trade, all of those sectors in blue have actually fully recovered and surpassed the pre-pandemic levels of employment. But you could see on the bottom portion in the red, accommodation and food. So leisure and hospitality jobs are greatly lagging. More than 1 million of jobs have not been recovered. Local government, which that includes teachers, also have not seen a full recovery. So that's the unevenness in the labor market, and also speaks to, even though the job market is quite healthy and we're seeing job gains, there's still a real lack of workers in many sectors. And that's why we have these, job shortages and leading to higher wages, which only, unfortunately, can propagate further rises in inflation. So wage gains themselves are not necessarily bad or unhealthy, but the Federal Reserve is worried that you get this wage price spiral, and that the experience that we had in the 1970s and 1980s could be redone, and we start to experience not just sort of somewhat of a temporary inflation period, but that one that would last over many years. And they really are very focused on making sure that doesn't happen. For the Federal Reserve, the worst outcome would be to have inflation well above their 2% target for several years, because they think it just distorts economic activity. So this is just a snapshot of the fact that the overall level of employment has fully recovered to its pre-recession level. We just got that with the August data. And it's just take a minute and see, it's somewhat remarkable. We know that there was a tremendous fiscal policy and monetary policy response, but you look back, you think back 2 years ago, it was hard to really imagine really that we would be back at this employment level. There were many people, as you probably recall, saying we were going to have long-term scarring, both in the overall GDP growth and in labor market. The good news is that we don't have that. We still have problems, but we don't have that particularly. So labor demand is robust, starting to cool a little bit, but I would say it's still very robust. The overall job openings to the number of people unemployed is back towards 2. So that means there are 2 jobs available for every 1 unemployed person. So there you could see clearly that there is this real tight labor market. And if you look at the sectors, particularly on the left, again, what pops out is leisure and hospitality, professional and business services, those sectors, education and healthcare. Those are the sectors are really seeing very large shortage of workers relative to the demand. And that's something that hasn't, it's going to be with us for some period of time. And that is one of the outcomes of COVID that has led to a drop in participation rate, and also some of those workers moving into other sectors. Equally, we can look at the unemployment measures for the U.S. and see we have a very, very tight labor market. So the overall official unemployment rate in August moved up to 3.7%. But what we saw is the participation rate finally increased. We had a 0.3 increase in labor participation. That it rose to 62.4%. So that means of the population eligible to work, 62.4% are actually actively looking for a job or employed. Now that's still down 1 full percentage point, pre-pandemic, and that is contributing again to these lower unemployment rates as well. And if you look at the red line, which is the U6, that's the underemployment measure. So that includes discouraged workers, and maybe some people think that's a fuller measure of unemployment. That's still relatively low at 7%. So again, very, very healthy yet tight labor market, and one that the Federal Reserve actually characterizes as being too tight at this point, and that there is not enough excess labor. How are consumers, navigating in the current conditions? So we're seeing them spend a bit more cautiously, even as inflation is cooling a little bit. Inflation, we think it's off its peak, it's off its boil, but it's still running quite high. We'll get the next measure of August consumer prices next week. We think the headline number is a bit lower, but that's really because energy prices, gasoline, have come down a lot. If you look at the core number, which strips out food and energy, there's still going to be an increase, we think, in the year-on-year rate, and you're going to be above 6% on core CPI. So still inflation pressures, and those are headwinds for the consumer. What we're also seeing with the consumer is this shift away from particularly non-durable goods purchases. So that's the yellow line. That went well above the trend that we saw in 2017 to 19, so pre-pandemic. It went well above it as consumers weren't able to spend on services. Now we're starting to see services trend higher, coming back more in line with what you would expect. The red portion, the durable goods, is still holding up relatively well. It has cooled since early 2021, but we're still seeing large demand for things like automobiles. And that's an interesting dynamic in this recovery. And it's really, the reason auto sales aren't even stronger is really a supply issue, not a demand. How are consumers, fueling their spending? Well, one, they're good income gains, and that's because the number of workers that are employed is very high, plus wage growth is increasing. It's running around 5%. Pre-pandemic, it was running 3%. But we're also seeing consumers use some of their excess savings that they built up during the pandemic, and that's a chart on the left. We estimate that consumers built up about 2.5 trillion in pandemic-related savings, and some of that is starting to come down, and that helps consumers deal with, especially at the middle income and lower income levels, but particularly middle income, because they have more savings to deal with some of these higher prices. Although we do believe that the bulk of the savings, unfortunately, actually is in the higher income levels. So going forward, we think many consumers are not going to be able to tap into the savings that they have built in, and we've seen an increase in credit, which I know Brody will talk further about. We also are keeping a close eye, of course, on business activity. And two measures that are very important and also leading indicators are the ISM Manufacturing Index and the ISM Services Index. What we have seen on the manufacturing side is that activity is still expanding. That measure is still above 50, which is good news, but it's obviously slowed quite a bit. And that's not a surprise. We're very quickly in kind of the late portions of a business cycle. Somewhat surprising because the recession just ended. It was a little bit over 2 years ago, but there's nothing normal about this expansion. We had a very quick downturn, and because of all the fiscal and monetary stimulus, we've actually catapulted to very late cycle. And that's, again, you can see that in the labor market, very low unemployment rate, very high inflation. And what we're seeing is some of the manufacturing activity cool. We're keeping a close eye on that. Again, these measures tend to be leading indicators. If we started to see some numbers dip below 50, that would increase the chances that we would have a recession in 2023. On the service side, things look actually better. They had cooled. They certainly have cooled since the end of 2021, the beginning of this year, but still relatively buoyant. We're seeing that both in new orders and business activity. So that's encouraging. And I think the service side of the economy tends to be less cyclical. So it does also support our view that if we do happen to fall into recession, we think overall it would be relatively mild and we'd have some support, particularly on the service side of the economy. Business investment in this environment, we think will continue to expand at a moderate clip. It's not going to be buoyant. I think there's enough uncertainty at this point that businesses are going to be cautious. And it's not just the US, it's obviously the global backdrop. There's the geopolitical concerns. Russia plays a role in, obviously controlling the natural gas and energy to Europe. Looks like Europe could quite easily fall into recession with the developments there and with gasoline, natural gas prices soaring. And also now they're threatening to curtail some of the shipments of grains and food from the Ukraine area. So that also just weighs on consumer and business confidence, and it's going to keep businesses have a tighter rein on an investment. The good news, though, is as demand is easing, we're also starting to see some improvement on the supply side of the economy, so that supply and demand are coming in better balance. And we have a proprietary supply chain index that we update each month, and what we see is an improvement really across the board, whether it's pricing power and pricing pressures, labor pressures, inventories are increasing, transportation costs are declining, and again, a little bit of easing on activity in the demand side it means that supply chains are starting to move with a bit more ease. That's good news for the inflation picture and really, at the end of the day, that's what the Federal Reserve is aiming for. They want demand to cool in order for supply to catch up and to eventually get inflation back towards its 2% level. Indeed, our forecast is that the Fed will eventually be successful. It's going to be gradual, the retrenchment in inflation. And if you see in the chart there that it's really in large part going to be led by a deceleration in goods prices. Now, if you look back at pre-pandemic, goods prices contributed very little to inflation, and actually in 2015, 2016, into 2017, actually goods prices were deflating, so they were falling outright. And it was typically service price inflation that was leading the way. But even then, inflation was was below 2%. So you could, many of us suggest the Federal Reserve was really challenged in trying to get inflation to 2%. Of course, you have enough stimulus, especially on the fiscal side, and you can get inflation roaring, and that's what we found out. But on the downside, we think again that the goods inflation, you don't even need to have outright price declines. You just need to have goods prices rising at a slower pace, and we do think that is going to play out. And we think service inflation, which is going to be sticky, we also see some deceleration there, particularly as home prices appreciate at a slower rate. Rental prices tend to follow with a 12 to 18 month lag. So as home prices, again, decelerate, not fall necessarily, but the growth rate decelerates, we think that rental price increases will slow as well. And that's going to take a lot of the pressure off the service side of inflation. The other thing the Federal Reserve is focused on and quite concerned about is that the longer inflation stays high, the more it can prompt inflation expectations to move higher and become unanchored. The good news is that long-term inflation expectations, so if you look at the blue line, the 5 to 10 year, it's increased, but hasn't become unanchored. And it's running around 2.9%. That measure does tend to run above the target. So the fact that it's above 2% is not worrisome. If it started to move to 3%, 3.5%, 4%, that would be much more of a warning sign for the Federal Reserve and prompt them to raise rates even more than they already are doing. The one-year inflation expectation is not a surprise that popped up. Less concerning about that. It's really the long-term inflation expectations that tend to lead ultimate inflation down the road. So, what is the Fed doing? Well, they're raising rates, and they're going to continue to raise interest rates, in our opinion. We expect that in the meeting in 2 weeks that they'll raise rates another 75 basis points to another outsized increase. And then for the full year, we look, including that 75 basis points, look for 150 basis points additional rate hikes. That would put the federal funds rate at between 3.75 and 4%. Markets are largely in line with our view. And then we think the Fed is on hold for much of 2023. We think that would be enough, but inflation's going to call the tune here, frankly. And if inflation continues to surprise on the upside, the Federal Reserve would be forced to do more, not less. Now, just shifting gears just a little bit, beneath the numbers, because we also do a lot of work on the regional and industry level. I thought this chart was interesting in that, all the focus on kind of the fundamental, what's happening in manufacturing and construction and housing, and yet, tech and tourism activity is really leading many of the metro activity in the medium to long term. So it's just something that's quite interesting, and to me, particularly the tech, that speaks to productivity gains, and that is always the key for medium to long-term growth. And the hope is, as we come out of this sort of COVID period, is that we do get productivity gains increasing in a material way, because that again is the backbone for economic activity. I just wanted to finish up a couple of comments before I hand off to Brody on the latest fiscal developments. And I would say also that the Inflation Reduction Act bill that was passed just last month is much smaller in scope than the fiscal packages that we saw during sort of the emergency COVID periods. And it's spread out over a 10-year period. But nevertheless, it is certainly a landmark and large step in terms of dealing with climate change, and it's in that sense is quite important. In terms of the overall impact on the deficit and also GDP growth, pretty, as I said, pretty moderate. We actually estimate, along with the Joint Committee on Taxation and CBO, that you're going to have a net deficit reduction of around $320 billion over a 10-year period. And the reason is that they're going to see tax increases with this alternative corporate minimum tax, which will raise about, as you can see in the chart here, $273 billion. There'll also be some prescription drug savings, and also there'll be increased, or the hope of increased enhanced tax enforcement, and that would raise $124 billion than otherwise would be the case. And you could see in terms of where the distributional effects in the chart on the right, it's estimated that it would really fall on the top 1% and even the top 0.1% of income earners in terms of increased tax enforcement. So it's not going to be a big drag, we believe, on consumer spending, because the top income earners have a lower marginal propensity to spend than the middle and lower income. And just, we've gotten questions, and I thought I would just share just where the impact of this corporate alternative minimum tax would fall. About more than about 60% or so would fall on the goods sector, but we'd also have a sizable impact across many service sectors here, as we highlighted. And particularly if you look at individual sectors, the sectors that are currently paying less than the 15% alternative minimum tax, real estate, technology, healthcare, those are the sectors that we would identify that would be the hardest hit by this change in tax policy. But I believe this is my last slide to share. I'm happy to take questions at the end, and I'm very happy to hand over to Brody so he could talk about current credit conditions in the U.S.
Well, thank you, Kathy. I was excited to hear, where we were trending and how the U.S. is performing so far, and especially with the impacts that we're seeing on consumers and what ultimately becomes impacts on business owners and small businesses. So thank you for sharing that with us today, Kathy. Appreciate having you here with us. Well, I'll jump right in, talk a little bit about the data that we use here for small businesses. At Experian, we bring together a lot of different data sources that cover different lending products that are available. We look at macroeconomic trends, just as Kathy walked us through today from the Oxford Economics perspective, which was a great story that leads us into our next deep dive into the activity that we're seeing within small businesses. Now, one of the things that I do like to start with, just as Kathy did, was to start with our consumer view. So how are consumers performing? So we talked about the pressures that were coming in from globally as well as domestically on consumers, savings rates, how they're changing over time, how that's beginning to dip down just a little bit in the amount that Americans are able to put away at this point, and that some of these consumers are digging into some of their savings to cover some of the cost of their spend. And I always like this phrase that has come out very recently. It's called revenge spending. So spending against when I was trapped inside due to COVID and the pandemic, I wasn't able to get out and spend. Now I'm out there spending and trying to just do whatever I can. And what we see is that the call for credit from consumers has continued to rise, and you'll see that in unsecured debt. Some of you may be looking at buy now, pay later products. We look at credit cards increasing, personal loans increasing. What you'll see is auto loans going up, and auto dealers, those originations, there's very little volume there from a supply side, but what's there is being sold and at a very high margin. So those lenders that are looking are and certainly some of those captive lenders are having some great years as they move forward. Mortgages are impacted. That market is softening, and you'll see those originations go down. We're going to see that through the next year. And like Kathy mentioned, how does that impact consumers? Well, that rental rate is going to follow as housing prices cool a bit. We'll see rentals hopefully come down in the next 18 months. That has a big impact on cash flows for consumers. And from a small business perspective, that equity is there really in the houses that they have, but it's a little harder to sell. We have 3 houses in my neighborhood that went on the market and expected to be gone in 2 weeks, and they've been sitting there for the last 30 days. So I think there's there will be some cooling here, certainly in the market, and we're already seeing it, just around us now. As far as delinquency rates, still significantly low. We're still in that pre-pandemic level. We're reaching some of those, certainly with some of our unsecured products out there for consumers. But I'll point you to the far right side, this chart looking at credit line increases and decreases across products. And some of you may be receiving some of these in the mail now, but we are seeing a heightened amount of credit line increases for consumers. As we get into our middle class range where the spending is there, it continues. People really want to get out and spend. They're looking for their credit lines to be increased to be able to cover that capacity that's being searched for from a consumer perspective. But the cash flow is still there. Employment is still heightened, and so folks are still out spending, which is good. So as we continue to look, how does this impact optimism? I always like to look at this when I think about consumer optimism, because it's really in conflict to what we're seeing as far as the spend metrics, employment, what's out there. Because you'll see that in the blue line in the very top, you'll see that consumer sentiment has been dropping off precipitously over the past year or so. Small business has been slow to follow. Businesses, as long as they're seeing the spend out there in the market, consumers are participating in their industries. We'll continue to see that small business optimism continuing to be fairly strong. Now, it has begun to trail and drop off a bit as consumer confidence has been at a low point for quite a while now. But we've seen some uptick in the past month or so in consumer confidence as well. So we may see that level out as far as small business confidence. But I think there are some indicators, some leading indicators that may put a little pressure on that confidence level for small businesses in the next couple months. When we look at hiring, and we look at surveys that are out there, well, you'll certainly see one of these. In evaluating how small businesses are looking to hire over the next 3 months, their hiring plan in general, been pretty stable, certainly over the past couple years, but in the past year or two, we've seen a real drop off in the expectation, certainly in the last couple months, to hire. As we're seeing some of those pressures come both globally and domestically, small businesses, not only are they having trouble hiring, but they may be starting to change their behavior as far as being a little more cautious about what's going to happen in the next couple months. Certainly as prices continue to go up for the products that they're looking to purchase from wholesalers and from the manufacturer, those prices are going up. So a little more cautious on how they're hiring and expanding their workforce, looking at how they'll invest in the short term to continue to grow through this next year. So I think those pressures will continue to be with us over the next quarter. Now, when we look at the originations that we're seeing across products, I have here both installment products and unsecured products. We look at both of these, installment products for that long-term perspective for a small business, and then unsecured lending, looking at the interest of small businesses. If they're going out and they're seeking unsecured credit, a lot of times that means that they're trying to invest in the short term and keep their cash flows moving along. So if they're having some reduction in cash flow, a lot of times they'll go out and that they'll increase their unsecured debt. We see that if you look at the top, you'll see installment lending has been pretty stable over the past year. You'll see that it's dropped off in the past quarter a bit. We're going to see that pull back as well in unsecured lending, down pretty significantly. You'll see that balances for unsecured lending have dropped as well. Now, the reason why that original amount has dropped is because we have a lot more small businesses seeking credit right now. That means that in those lower tiers, those tiers that are a little bit more high risk, they're out there seeking credit, and they've been getting credit over the past couple months. What that does is it means at a higher risk, what's your underwriting policy do? It drops that amount down, and so it doesn't allow as much to be lent, and that means the average overall for the amount being lent out by our commercial providers has dropped off a bit, and we'll continue to see that be pretty low over the next couple months, but begin to rise again. And we'll talk about why we'll start to see the rise in those credit limits. And here's just another, as we look at small businesses out seeking credit, you'll see we look at inquiries for small businesses that are out there. You'll see on the bottom chart that we've seen inquiry demand rising. Certainly across surveys that I've reviewed, we've seen that go up. Even in our own portfolios, we continue to see inquiries rise for small businesses. Some of those that are in more of a credit crunch, industries that aren't seeing cash flow develop as quickly as they'd like here in the last part of 2022 are looking for a little bit extra credit to build up or buffer some of the cash flow challenges that they're having to keep their business flowing. But you will see that increase in high risk small businesses, those that are having a little more trouble not paying their bills on time. They're a little lean on their cash flows, really seeking credit at this point, and you'll see that big increase. You know, even from this year, or from the previous year to this year, about a 59% increase in the high risk increase coming through the door. So you guys are probably seeing that as far as what your input volume is looking like. Now, when we look at usage across the US, what you'll see, I'd like to look at utilization, because we talk about what's coming in. If we see higher risk accounts seeking credit, it means their utilization is increasing. And you're certainly going to see that across the US, that utilization is starting to tilt up, certainly for small businesses. On the consumer side, pretty stable. We're seeing a little bit of uptick in some of the higher risk segments from a consumer or business owner perspective. But from a small business perspective, looking at their commercial entity only, we're seeing more of that increase in utilization, and we're certainly seeing it focused in our supply chain industries. So when we talk about manufacturing, we look at our wholesalers that are out there with, you know, a lot of inventory building up. Our retailers, we see that continued utilization as they prep for the holiday season has increased over the past quarter. Now, as that utilization is increasing, are they getting credit line increases on their credit cards? Not as much as last year. You know, as we saw it last year, we saw strong stimulus, as Kathy spoke to. We saw that there was a lot of savings that was available to business owners as well as businesses as they had the PPP loan to additional funding there that added to their cash flow. They're able to leverage and create more opportunities, and lenders like yourselves would be more willing, knowing that repayment potential was much higher. And so they gave a lot more increases in last year. This year, we're not seeing as many at all. So let's look at delinquency trends. So are the delinquencies going up? Is that what is causing credit to, for us to not see so many increases in credit lines as we look out? Is that what's causing this increase in delinquency levels across the US? Or an increase in the higher tiered, higher risk inquiries that are coming in, more volume to be seen there. What we're seeing across the US is you'll see delinquencies are pretty stable. We see a little bit of an increase in the South, and we're going to continue to monitor that. Generally, as we look across the US, fairly stable. What you'll notice in the far right chart is that we see our sloppy pay delinquencies, fairly stable and low, pre-pandemic level low. That's what we expect them to be, but they are on the rise. And that means that we're feeling a little bit more stress. If you think about sloppy pay, if you're having trouble paying your bills, you might let a credit card roll 30 days. Not good for your credit score. And those of you that monitor your credit score every week or every month or have it on your phone app and you flip through, again, not good to go into that 30-day, but sometimes it's maintaining your business and your cash flow. You have to make a choice. And so for some of these businesses, they're making a choice to go a little bit more sloppy in the repayment policy to hold that cash a little bit longer. And so we're seeing those 30-day delinquencies pick up a bit. What's good here is that our 90-day and 60-day delinquencies are trailing behind, but not at the same velocity as our 1 to 30-day. That's good. What what we will be watching for, and if our macroeconomic environment here in the US degrades, or we see some more challenges, a lot more of those pressures come in, we may see that 90 days, that those businesses that rolled into the 30 have to keep rolling into those more high delinquency buckets, and that's what we don't want to see. When we see that 90-day go ahead and cross over the 30 or the 60-day trends and become higher, that means that more of these businesses are rolling into these higher delinquency buckets. There's a good spread in between those right now. Again, what we're saying is that consumers and small businesses are still in a strong position, still out there investing, but we are seeing delinquencies just tick up a little bit. We're seeing some pressure in the market, certainly on increasing prices in some of the development of products. What's good is that we're seeing transport is going down, certainly from global imports that we're seeing coming into the US. The dollar has been strong, so being able to import and bring those products into the US has certainly helped to keep those prices moderated a bit, but inflation continues to push that up, and supply chain challenges getting that to manufacturers has been a challenge. Now, when we think about what's happening, again, I like to show this. This looks at delinquency trends within the portfolio. So this means businesses that already have credit, this is what their credit looks like on the book in the US. So if you think about your own portfolio, this is how a breakdown might look and how you might compare your own portfolio to what we're seeing in the US. Again, when we look at each one of these bars in these sections, we're looking across industries. And as we're seeing some of the yellow bars expand, that means that you're seeing more 30 to 60-day delinquencies. The blue bars are 60 to 90, and then 90 plus in the purple. As we see that expand, that means delinquencies are getting higher in each one of these industries as we go across. And you'll see some big dips in a lot of these as we go across a lot, as you focus and look at some of those supply chains. Now that's easing a bit. The last time that we got together, we saw big differences between last year and this year. We're seeing a lot less of that differentiation year over year in delinquency rates at this time this year. So again, we're looking at the strength of small businesses. The resiliency is still pretty high. A little bit of sloppy pay there will push them into some higher delinquency buckets for some small businesses. But again, at pre-pandemic levels, very low. These are really, as we've looked over the past 2 years, these have been historically low delinquency rates. So still in a good position, again, to weather the headwinds that may be coming over the next 6 to 12 months. So when we think about 6 to 12 months, let's just think about the next couple months. So as we think about retail, and we think about the holiday season, and you guys are about to get out, do some holiday shopping, pick up some gifts, look for a computer or television, or pick up toys for your kids or for family or friends. There's a lot of inventory out there. You know, as we went through the supply chain challenges last year, and all our conferences were supply chain. Even my kids say, "Dad, what is it? Supply chain that's getting us?" It always seems to be one that makes me smile, and I say, "Yes, kids, you're right. You're super smart. Supply chain." So what's been happening is those that were challenged last year, even those that worked through the supply chain issues from an ordering perspective, over-ordered this year in preparation for the holiday season and for back to school. And what we saw is that those inventories are pretty flush. That means they're not ordering as much right now. And so that's why we're seeing some of the transport prices begin to come down. We're seeing oil and gas prices come down. It's really helping to bring down the costs, but we have inflated inventory. So you're going to see some retailers that are trying to get rid of inventories over the next couple months. You'll see some good sales coming out. It will bite into some of the margins that retailers have out there, and they'll call back some of the margin, some of the advancement they have, their profit levels for the next year. And so we'll see some bumpy roads here for retailers over the next couple months. But again, if you look to the right, delinquency levels are low. They may have overordered. We're going to see some sales. It should help inflation as we're out there, and we'll see some price deflation here, at least leveling out on some of the prices that we've seen for goods as we go forward. So an interesting story that will play into what we see over the next couple months as retailers begin to get rid of some of this inventory. So I want to bring up a poll question. And you know, as we've gone through some of the macroeconomic challenges that could be happening in the next 6 to 12 months, you know, as Kathy looks at what's going to happen, certainly from a Fed intervention as we raise rates, you know, up to another 75 basis points in the next call, up to 3.75, 4% overall as a target. And we look at how that's impacting small businesses right now. Prices are going up, they're containing margins, they're seeking credit a little bit more. What are you thinking? I want to put this in front of this group and say, you know, as you look at these current conditions, is it prompting you to begin to adjust your credit policies? So are you tightening credit right now? Are you loosening credit as we get into the holiday season, knowing that there's still some savings there for consumers and potentially small businesses, and opening up credit a little bit more as we saw some of those credit line increases on the consumer side? Or are you going to just keep business as usual? So take your mouse, click on one of these. Let's take a look at the results. We're going to hold it open for about 10 more seconds, and then we'll jump in. But I think it's a good one. Then what I'll do is we'll take a look at your results, and then we'll look at what we've seen currently for both consumer and commercial credit policies over the past few quarters. So Gary, how are we doing? Do we have the results ready? Very interesting. So tightening credit policy as we go forward. You know, when I met with some of our advisory councils across different industry groups in the past 2 quarters, you know, a lot of holdback on tightening credit, looking at the amount of spend and that keeping that spend moving to keep the economy rolling, seeing a lot of the savings that was there that could accommodate that repayment of the debt as we're moving forward, really the strength in the consumer and small businesses in the US. So tightening credit definitely was not on their map, but now as we're moving forward, we see some of the delinquency rates moving up. Let's see what our credit trends look like within the consumer and commercial credit here at Experian, and then see if we're seeing that tightening that you may have been thinking about over the past 30 or 60 days. So we look at a survey by the Kansas City Fed. We look at the expectations of tightening lending standards. You know, it is starting to pick up. Certainly in the first and second quarter, we saw that tightening of lending standards being thought about, but not, I wouldn't say acted on in our first or even the first part of our second quarter of 2022. But what I will tell you is that we're starting to just see a little bit of that, starting to see the signals, and certainly on the commercial small business side. What we saw from within this year, so within the past quarter or so, we've seen a decrease of about 13% in high risk underwriting. So that means taking in those higher risk accounts and approving them, giving them credit. We've seen a decrease in that and an increase, 20%, 22% or so increase in low risk being booked. So those are your super prime customers that are coming in with business and asking for credit. We're seeing the volume of those go up. So that's a leading indicator to some tightening of credit in the commercial market and certainly for small businesses. Not an over tightening, just the beginning of looking at credit policies again, making sure businesses are in a good space as we move forward, that their cash flows are adequate to cover costs as they move forward into the next couple months. So a little bit of tightening here that we're seeing in the commercial market, but again, remember, consumer and commercial spend and performance has been pretty strong coming through the pandemic and coming out of the pandemic, still pretty strong. Now, when we look at from a consumer perspective, we again see consumers are out there, a little bit of that revenge spending, going out looking for credit. So the inquiries that we're seeing certainly for this year are higher than we've seen it in prior years, even pre-pandemic. But what we see is from an origination perspective, you see it's been pretty stable throughout the past couple years and remains that way. So from a consumer perspective, we're not seeing that same credit tightening that we're seeing just a little bit of from a commercial perspective. So when we get into and we start thinking about the next couple months, we know that some of the consumer behaviors will likely begin to tweak a bit. So as inflation continues to be strong, consumers are going to make different choices on whether they are looking at premium products or they're moving down to those store generics, and we've seen some of that across income bands, that switch to more generic level products. You'll see that lingering inflation and cost containment are going to be high on the minds of small businesses. Certainly as we move forward, inflation was at its highest level from a small business survey that we reviewed, and it certainly is on the mind there because that's cost. That means that they at some point will need to pass that on to their customers, and that can impact cash flow as they go forward. So small businesses are definitely thinking about that. Delinquency rates are rising just a bit, and you know, as they're rising, our small businesses are going to be looking for opportunities to shore up and be sure for the next year or so that they are on good, stable ground. So you'll see a heightened velocity in inquiry volume as we get into the next couple months. As we get a little bit more of the slowdown from some of the Fed activities, you'll see small businesses seeking credit at a faster pace. We're going to continue to monitor to see how our policy changes, any way that we're looking, bringing in alternative data to evaluate businesses, anything that we can do to keep those gates open for consumers and small businesses to borrow. But we probably will see a little bit of tightening over the next couple months, and we'll continue to monitor that and bring that to you. All right, so Gary, Kathy, I want to see if there are any questions that we can talk to this group about or answer any concerns that they may have from some of the metrics that we've shown today and some of the signals that we've seen.
Yeah, there were a few questions that came in here. We'll see if we can read a few of these. There was one question from John. What direction do you see office vacancy rates moving in the next year? Any insight on that, Kathy?
We expect that it will gradually diminish the vacancy rates, but there has really been a large change in in behavior rate and sentiment. So like many of the measures, it's probably going to really lag behind the pre-pandemic. And I think it's an evolving calculation, to be honest. What I could say, anecdotally, being in New York, there's been a really big push to get employees back into the offices. And I think the jury's still out to see how that plays out, and then indeed how companies react to that.
Very good, very good. Daniel wrote an excellent question here about savings. He says, we continuously hear consumers are using their savings. Most time in the US, consumers had no savings. Many years data showed negative savings. Why is this having such a focus? News reports about this all of the time.
Well, it is a good question. I think the fact that we saw a savings rate rise so much, that's was news for many U.S. Americans. I mean, U.S. consumers, tend to, on average, see a marginal propensity to consume out of their income as being very high. In other words, savings rates, tend to be low. That said, they are positive. Even historically, you would see a savings rate, running as it is now. It's running about 5%. It's just that during the pandemic, at one point, the height it went up, sharply higher, and seeing, large double-digit gains, which is not at all usual. So when you aggregate, what was the pre-pandemic? Actually, pre-pandemic savings rate was about 7.5%. The fact that we're now down below that and 5%, that means that, by definition, you're seeing dis-savings, right? And you're seeing consumers tap into that savings, and it's sizable, over 2 trillion. And that was really because we couldn't spend it, right? It was forced savings because we weren't able to engage in service expenditures, which is still the largest share of our economy. The question really going forward is, who holds the savings right now? I think that's what's critical. And from our estimate and work that the Federal Reserve has done, that a lot of the, lower income and maybe even portions of the middle income cohort have really extinguished a lot of that savings, and a lot of it now rests with the higher income households, and they just have a lower propensity to spend than and to save more. So it may not be that we get additional support from that savings going forward.
Excellent.
Kathy, we see the same thing. I think it's that propensity to spend, as you talked about. Lower middle income, they're needing to spend it from a cash flow perspective and paying bills. Higher income, they have the ability to spend, but right now, with some of the economic pressures and inflation continuing to be volatile, they may be just holding back and preparing for, the next year. So we may see that overall savings can just level out, but the savings rate drop off.
Well, we'll have to leave that there. We've got a few other questions, and we'll try and blog responses from our experts. We'll route these after the webinar. So thank you for submitting your questions, folks. For additional information on the work that Oxford Economics does, the fantastic work they do here on the economy and macro insights, you can find all of that at oxfordeconomics.com. For more information on Experian's business information services and products, you know where to find us, experian.com/B2B. We've got an insights, a commercial insights hub now. So we've got lots of other insights on small business available on our website. Greatly appreciate your attendance today. Please, if you could help us with this one favor, we have a short, I think it's like a 3-question survey at the end. Your responses are so helpful in helping us to craft these webinars. So please leave us some feedback when you exit today. And thank you, everybody. And that'll be the end of our webinar for today. Have a good day, everyone. Thank you, Brody, and thank you, Kathy.